right, it looks like everybody's made their way in to the meeting out of the waiting room. So I want to just start with a welcome, of course. We are so glad you could join us today. I'm Sarah Delahanty, financial advisor with SYM Financial Advisors. And today, along with my teammate Brad Dooling, we are distilling down the recent changes of the Dow Total Rewards to uncover the best ways to help you maximize your employee benefits, provide some insight regarding future savings opportunities you could consider, and really just to kind of fine tune, the changes that have come out and really help you make the most of them. So our goal today is just that. We want to make sense out of the changes. We want to call out some opportunities where you may want to engage a financial professional and ensure you're tracking towards financial independence, which of course is what everybody wants, right? I mean, we want to make sure we're tracking in the right direction towards retirement. Brad and I are principals of the firm and also certified financial planners. And at SYM, we provide financial leadership to executives at Dow and a wide variety of companies in understanding their executive compensation and benefits exceptionally well. So today, first off, a little bit of admin as we get started, just wanting to make sure everybody, kind of knows the rules of the road with virtual meetings. I'm sure we're all experts at this point, but please make sure you're muting yourself during our conversation today. And obviously the bulk of our day actually is meant to facilitate questions. So we'll start the first half of our session today with discussion of the benefits. But what we want to do is we want you to engage with questions throughout that discussion. So please use the chat box to do so. Close up to our session, we will then, of course, address that in the second half of our discussion today. So it really is important. We really want this to be more of a town hall, more of an open discussion, really answer your questions and spend, like I said, a kind of a bulk of our time on that. So our moderator, Ellie, will read your questions too. So don't feel like, you've got to speak or pipe up. Just go ahead and use that chat box function. And then our moderator will read those questions at the second half of our call. So again, just looking at that key question, the key questions we are aiming to answer today are such. And we really want to spend the time on how do we optimize the new benefits? How do we maximize the in-plan savings opportunities? And how do we prioritize those competing priorities? What other savings opportunities do we have, given that there's some changes that are happening over the coming years that may influence our ability to save outside of the plans? And then what is a qualified employee stock purchase plan? This is new, right? It's bringing back the employee stock purchase plan, but it's taking it to a different step, right? We have a qualified plan, so we'll talk about the distinctions of that. And then of course, any nuances that you should consider for your planning purposes. And then lastly, how do the changes affect our financial future? We really want to talk about your financial future, the questions you should be asking an advisor, the things that you should be seeking out and discovering for what best fits your financial situation. And then how can a trusted advisor help? So if you've been a do-it-yourselfer thus far, or maybe you have an advisor and they're not maybe asking these questions or answering these questions, we just want to spend a little time on that to give you that critical lens as to what you should be thinking about next. And obviously tracking towards that financial independence we talk about. So let's go ahead and dive in. Our first conversation point today, of course, is how do we optimize the benefits and what has actually changed? So let's talk about what's actually changed in the 401k. So how we can actually optimize what's coming up before us with the changes.
Yeah, let's start from the beginning. And so with the 401k plan, we have employer contributions as well as employee contributions. And so the first change is going to be the smallest incremental change that we'll talk about today, but that's just going to be an increase in the matching contribution. So some added benefit for employees over the next couple of years, going to a 5% matching contribution from the current 4% contribution. So nice to have some additional employer contribution there. And 2 years in advance of having the pension plan frozen, which is obviously one of the major factors that is probably drawing people into our discussion today. The big change with that, though, really, and the key difference of the contributions going forward is including bonus pay on the employer matching contribution. So up until this point, your base salary has been includable compensation. Starting next year, when we go to a 5% match from Dow, both base pay and performance award, actual received performance award will be eligible compensation. So that's a great
That
feature.
really opens it up quite a bit, right? Because I mean, obviously, bonus for a lot of folks is a pretty big piece of their overall compensation. So what about the includable compensation? Because the IRS says, hey, you know, there are plan rules in a 401k plan. So now that we're really opening up that opportunity by including the bonus pay, what's the IRS ruling that we need to, you know, kind of frame it in a little bit based on that change?
So the IRS has several limits with 401ks. We're familiar with the contribution limits as employees, being able to max out $19,500 per year, maybe a catch-up contribution over the age of 50. But the compensation that can be considered toward any type of contribution is limited to the first $290,000. So that's a big number, but with including your base pay and performance award in that number now as part of the eligible compensation, it does cause there to be a little variability there for one, which requires some planning, but also allows that compensation to increase to the point where some people may be above that limit that were previously not. And so the question then is, can I get that compensation matched from the company or not? And I think that's a big question that we see all the time is how is that going to be made up for me?
Mm-hmm. And so the nuance to that is now it'll spill over into the deferred compensation plan and the dollars that exceed that 290 of includable compensation. And then the employer will provide the employer contribution to those dollars above inside the deferred compensation plan. So I think that that's really, again, a nice enhancement, kind of bringing up the level of benefits and the employer support for those benefits, but really a neat opportunity for some, you know, who have the compensation that exceeds that point.
It is. It's a nice feature. And so I think more Dow employees over the next couple of years will become familiar with the deferred compensation plan, the elective deferral program, because really this is just, you know, we've touched on one change, the smallest change. The next change is really a couple of different things that will happen all at the same time. And so at the beginning of 2024, end of 2023, however you want to slice that up. But the pension is frozen at that point. So no additional credit for service, no additional change to your compensation level, which is used in the calculation of the pension benefit. So all of that is frozen as of December 31st of 2023. But coinciding with that is going to be a new contribution also to the 401k plan, an additional 4%. And it's called a non-elective contribution, meaning you do not have to take any action. Dow will automatically do that on your behalf. For the matching contribution, of course, you need to defer at least the minimum amount to get the matching contribution, which we hope everybody is doing. But this new contribution in 2024 takes the total to 9%. And it also will continue to use up some of the 401k space, which we'll talk about here in a few minutes, what that means for savings strategies. But it's a nice added feature as well to get that additional compensation from Dow.
Yeah, and so that's a great, you know, just to kind of draw that out a little bit for everyone that's joined us today. I mean, it's different, right? I mean, there are pros and cons to pension plans versus 401k plans, and making, you know, that switch between you being in the driver's seat and having a little more accessibility to the funds. And so let's talk a little bit about the pros and cons of that, because I think it's important, as you know, this has been a real big shift in the retirement, you know, thought process for a lot of our people who are, you know, impacted. And so let's talk about that for a little bit. What are the pros and cons to one plan versus the other?
They really serve similar purposes. So defined contribution plans, which is the 401k, really are just that. It's a contribution from either the employee or the employer. Contrasted that to a defined benefit plan, which is your traditional pension program. So employees like pensions. Of course, we see in our industry, pensions don't exist that much anymore. And so, but the employee having that known pension payment, that cash flow in retirement is a great benefit. Hopefully, and I think Dow's done a great job of communicating this, you're not losing anything you've accrued up until this point. So that's still an important part of the retirement plan.
Mm-hmm.
And the advantage of a pension is, not bearing the investment risk directly yourself. The company is managing that on your behalf. And so it can be really a conservative part of your financial plan, but it's also locked in. There's not a lot of flexibility in what you can do there. Switching to the defined contribution method, so your contributions plus the employer contributions shifting in that direction gives you a little more flexibility and control over different elements. So how do we invest the funds? How aggressively are the funds invested? Again, there can be some risk there. If you really are not sure how to do that, then seeking out some advice is probably appropriate. But it also gives you the flexibility of how to use those funds in retirement. So while there are some rules around when you are required to take money out of a 401k plan, the flexibility of taking certain amounts earlier on or deferring until later on, depending on your cash flow needs, does put you in the driver's seat, which is a good benefit. It really does provide some additional flexibility when you're considering a well-rounded plan.
Yeah, absolutely. And I also would say, this becomes kind of that question of where does the cash flow come from when we retire, right? How do we recreate the paycheck? And we talk a lot about that with our clients with frequency. And so, it's the $1 million question, right, Brad? Am I saving enough? Where's it going to come from? How do we answer those questions given the shift?
Yeah, everybody really does need to take a look at their individual circumstances. The pension is an important part of that, and the contributions going forward will change. But really looking at your cash flow in retirement, looking at what does retirement look like for me is an individualized question. So that's where some personal planning comes into play. The pension number is not necessarily the most important number out there. It's just one factor in meeting your goals. And so that's where you really do need to take a look at what resources are coming in during retirement years and what resources are going out, and how do I best match those up. And so we'll talk in a minute about kind of prioritizing how we get from today where we're sitting in the savings category, trying to get towards that road, and then switching over to spending those assets and using them in retirement.
Yeah, perfect. And so I think that transitions to our next question pretty naturally, which is how do we maximize the in-plan savings opportunities? So we always call this the dollar Olympics. There's a lot of competing priorities for our paycheck dollars. We obviously want to pay ourselves first. That is a critical step in making sure retirement's tracking in the right direction. So let's talk about, what is the best way, which plans, what opportunities do I prioritize or triage first, second, third, as I think about, I only have so much paycheck. So before I run out of paycheck, how do I divvy up this and make it work for me, but also, make sure that I'm taking advantage of everything to the best of my ability.
I really like that, the dollar Olympics. It's an interesting way of thinking about that. So there are areas of savings that have more benefit than others. And so you may want to even write this down, because this is going to be some prioritization of how those dollars are allocated from a savings perspective. There's
a test later, by the way. Just kidding. But seriously, this is really a part where you should take note. It is really important.
So the first priority, I think, makes sense to most people. That's going to be your pre-tax deferrals into the 401k plan. Those are matched by the company. As we said, that match is increasing. It's also increasing to include your base pay as well as bonus pay. So at least the minimum to get the maximum matching contribution there. But I would take that a step further and say we really should be maximizing that to the full $19,500 per year per person. Those are 2021 numbers. If you happen to be over the age of 50, there's an additional $6,500 per year that you can do as a catch-up contribution as well. So that's priority number one. We need to not leave any money on the table, max out those benefits. You're getting the pre-tax benefit in the 401k plan. The second opportunity, we focused a lot on the 401k plan, even a little bit about talking about salary deferral through the elective deferral program, but we're going to step outside of those plans for our next priority. And the next priority is going to be the health savings account. So that's a unique element that we can look at from a savings strategy standpoint, but fully funding your health savings account is going to be priority number 2 for saving from a long-term perspective. And so that's $3,600 per individual, or double that amount, $7,200 for a family, and then a catch-up contribution at age 55, not age 50. That always trips people up. and that's another $1,000. So those are going to be our first two priorities, and we could probably talk a little bit more about the health savings account strategy. That's kind of its whole nother session we could do,
Sure.
but that's going to be a really good opportunity for employees.
So, and why do we pull that HSA? Like, let's talk about that for a minute. Why are we pulling that HSA up behind the 401k deferrals in line? What's the nuance there that everybody should know?
Well, we have an entire white paper that we've written for this strategy, but health savings accounts exhibit three tax advantages, which is very uncommon. It's actually the only way you can get triple tax advantaged savings opportunity. So the money going into the HSA account is tax deductible or excluded from tax if you're doing it through payroll, including even your FICA taxes can be excluded if you do that through payroll deduction. So that's your first tax savings. The money in the health savings account will grow tax deferred while it is invested, and we do recommend generally investing the funds through the HSA. So there's your second tax deferral. And then third, if you use the money later on after you've had some time for it to grow in retirement, for example, and you withdraw money from the HSA, it can be tax-free. So the third tax advantage. And really just it's tax-free whether you spend it on medical expenses or not at the time, because you can use reimbursements for medical expenses that have occurred in the past. So as long as you have an expense that you can link that withdrawal to, it doesn't have to be in the same calendar year. So it's a really flexible way to gain tax-free withdrawals from that account. So I think more and more people are getting familiar with HSAs as the industry has shifted, but it's a really good, not only a way to save for healthcare, but it's a great investment opportunity as well.
Mm-hmm. Absolutely. So then what's up next? So we talked about the first two. What's the third position point here then as we prioritize?
So the third opportunity is going to go back into the 401k. And so the 401k, especially at Dow, has a unique feature called after-tax savings. If you have worked your whole career at Dow, this may seem like something that is, you may be familiar with it. It may be something that you think is available all over the place. We can tell you, working with other companies, it's actually very unique. Most employers won't be able to offer this just because of the discrimination testing that 401k plans exhibit. So after-tax 401k savings are in addition to your contributions, the $19,500, and in addition to the employer contributions. So stepping back out a little bit to go to the IRS guidelines, there's a $58,000 total annual contribution that can be made to the 401k, which includes everything the employee and the employer is doing. So if we look at 2021, that $58,000 contribution, if you are at the compensation limit, so we'll just use that as an example, $290,000, that $58,000, you're using up $19,500 from salary deferral. The company is putting in some additional funds for you through matching, and that leaves $26,000 that you can put in after tax money. So you may say, well, why would I want to do that? It's after tax money. It's already been taxed. What's the benefit? In the 401k, it grows tax deferred. So you do have tax deferral opportunity there to save taxes, but you also have the opportunity to convert that into a Roth IRA, either through an external Roth IRA or even within the plan itself, you're able to do that. And now that money becomes tax-free as it grows through your retirement timeframe. So a really unique opportunity to get a significant number of dollars into a Roth IRA on an annual basis. And so that's going to be our third priority.
Yeah, that's definitely, that's a great priority. And let's talk about this too. So there is kind of a narrowing window that's happening because the employer contribution is going up over the years ahead. So we have an opportunity for after-tax savings today that's X, and eventually it's going to be less than X. So let's talk about that, because it does constrain it quite a bit as the employer contribution goes up to its final stopping place in 2024. Yes,
for sure. The employer contribution, we want that contribution. That's free money to us that the employer is providing. So while the after-tax opportunity will be diminished a little bit over the next few years, it's still a good thing because we can direct that savings elsewhere. But as that $58,000 is really set, it does increase with inflation each year. But if Dow is putting more money in starting next year and then even more money in 2024, the $58,000 limit doesn't really change much. And so this year it's about $26,000, maybe more depending on where your compensation comes in. In 2022, it'll be a little bit less. That will just decrease because of the 5% contribution to the plan. So about $24,000, just in our hypothetical example here. But in 2024, that's going to be cut in half again to about $12,000. So still a great opportunity to get $12,000 ultimately into a Roth IRA, but much less of an opportunity going forward because the company is utilizing more of the room in the 401k plan for their contributions.
Yeah, it's a great opportunity because as you all might know or have heard, there's some income limitations to directly funding a Roth IRA. So to be able to do it through this mechanism, through the 401k plan, is so valuable. It allows you, even if you can't max out, so to speak, we really, encourage you even to do as much as you can through the payroll process to optimize this opportunity because it's a neat one. It's kind of a unicorn in the company benefits space. So it's unique to Dow's plan and one that you'll want to take advantage of as that, again, it will narrow quite a bit in the coming years. But let's talk about the last piece of this. So what's the last component of the plan dollars as we've sliced and diced everything through the dollar Olympics? Now we're to our last piece, which is the employee stock purchase plan.
Yes, and it's interesting because the employee stock purchase plan is a great benefit as well. And we're going to talk in a little bit of detail about how that program works, but it does take the priority kind of behind the other three options just because we're competing for the paycheck dollars. And so some of you on the call may be saying, well, I've already run out of paycheck dollars if you have me do all of these things that you've laid out. So because the current new program will use payroll deduction only, there's no option to put money in a lump sum. It does have some limitations there in how you fund that. So, but it is a great opportunity if you still have paycheck available, maybe even to the point where you're spending out of some savings that you have on hand.
Last year's bonus,
yes,
something like that.
To live off of, because we realize we're good at as financial planners of finding ways to save money, but we also realize you do need to be able to do the things you enjoy doing and cover your daily household expenses. But the employee stock purchase plan is going to be the next option that we would look at.
Great. Yeah. So now that we've got the priorities lined out, eventually there may be other opportunities for people to save. So let's say somebody's like, hey, I maxed everything out. I'm doing it all. What next? And obviously what next as some of the opportunities, for example, the after-tax opportunity starts to narrow a bit in the years ahead. What are other savings opportunities, especially because we may not have as much, expectation for the pension, obviously with that implication happening with the accrual of benefits. What are other ways we can save outside of employer plans? And what are some opportunities that everybody can think about if there is, more to the dollar Olympics, more capacity?
I think one of the great ways to save, and there's some benefits in retirement planning to saving in an investment account, a non-qualified. And when we say non-qualified, what we really mean is an investment account that doesn't have any current tax deferral benefits. So a joint investment account with your husband or wife, individual account, your trust, whatever that happens to be. That's a great opportunity to save if you have excess money from your paycheck, your bonuses, as you work out of long-term incentive compensation. Those are great ways to save money in that type of an account. And it's a good opportunity in retirement because we like to have diversity of money sources as well, because having to go in your retirement years and every single withdrawal that you take, having a tax consequence can be undesirable as well. So it's nice to build up some diversity there in types of investments. And so that's a great opportunity. There's another opportunity as well, similar to the after-tax savings that we talked about in the 401k, and that is Roth IRA funding. Most people that we're talking with are going to have some income limitations on putting money into a Roth IRA because that does have an income test before you can directly deposit to a Roth IRA. But there are ways around that. There's something we coined in our industry called the backdoor Roth strategy. I would say proceed with caution there, though, because you can run afoul of some of the steps. If you're not sure how to do that, that is something you really should look for some professional advice on, because it should be a tax-free strategy when you do it right. But if it's done incorrectly, it could in fact result in some taxable income. So that's another way to additionally build up some resources.
Yeah, that's great. And I think that, but back to some of this can be a little complex. So we realize, again, we really want to welcome your questions. So again, just as a reminder, go ahead and put those in the chat box as we go. And we also welcome individual conversations. So we realize all of this isn't going to sort of hit you today either. So again, to invite those ongoing conversations and engage with a professional, because again, we do this all the time. We can help you with those personalized decision points. So I think that that's important to say as well. So let's transition next to the employee stock purchase plan. So for many of you, this is a flashback. This is bringing back an old benefit you've already known well. This now, the nuance is a qualified employee stock purchase plan. So how do we make that? We talked about the priorities, right? We're prioritizing the dollars as we delegate dollars for these opportunities. But what types of cash flow planning, what are some things we could call out to consider if people are interested in participating in the plan? There's some nuances to this plan that are different than the plan we may all remember from years ago. So what are they?
The first thing is the qualified plan is structured in a way that really gives some benefit to the employee on how the price is determined. And so this plan has what they call the look back feature. So the program was offering just started. So you probably all received an email already with enrollment details. So if you have the ability to participate, you have enough money and room in your paycheck to defer for the next 6 months. The discount that you have will be based on either the offering period price or the end of the period price if it happens to fall. And so discount is 15% from that. So it's a great opportunity to build in some potential gain with the program. So we do like it. It's a really good, unique way to build up some automatic savings and to direct some funds in that direction. Really, the question with the qualified versus non-qualified piece of an employee stock purchase plan is tax related. So there's a lot of emphasis on qualified plans and how we have preferential tax treatment when we dispose of the shares or sell them in the future. Mm-hmm. And so that's one where there really is no clear right answer. And a lot of it will depend on what is the offering that you attain through either the look back period, so beginning or end of period. What is the market price at the time that you want to sell those shares? And so there's a lot of considerations. And unfortunately, I think the answer is it depends. Which is not an answer that we as planners necessarily like, but that's the one that we have for that program. But it is a great opportunity to build up some savings. Yeah, so I think the message there is it's a great wealth builder. It's a recommendation, if you can facilitate it through the payroll deduction. But again, size it appropriately, understand, the tax implications, engage with a professional to determine your specific tax situation so that whether or not, holding a position, again, a pretty highly concentrated position for most people, or the pros and cons of selling the shares as soon as they're received, or selling the shares and waiting for the 2-year period to get the special tax treatment. So again, that'll be pretty specific as we mentioned, just for your specific tax circumstances and the market dynamics at the time that the shares are delivered. So I think that one is, again, a neat opportunity, wealth building opportunity, but again, we'll sort of say it depends in terms of any kind of recommendations. And again, welcome questions on that front as well. One thing I think it is important to write down related to the employee stock purchase plan is if you do participate, you're going to want to just make a mental note, a physical note, whatever it is, to prompt yourself to really look at the reporting of taxation on that when you do eventually sell the shares. Because regardless if you have a qualified or a non-qualified disposition of the shares, it's very likely that you will have to make an adjustment on your tax return to report that income correctly. We've seen that with the old employee stock purchase plan. We expect there to be some issues here in the future as well in terms of how that cost basis, that original income is being recorded for employees. And so it is going to be very important that if you hold those shares for a number of years, it's very easy for some of the details to get lost in the shuffle. And so definitely want to make sure that you really segment those shares outside of your other Dow shares, because there could be some adjustments you need to make on your tax return.
Yeah, so that is a good cautionary tale. So it is taxpayer reported. It's not at the level of the custodian, meaning Fidelity in this case, to keep the record as to that cost basis. So that's on all of us to be able to, note that and keep record of that. And so and again, we find that it tends to be a bit of a tax trap for people if they don't have that mental note. So that's a really great one. If you're going to write anything down today and you're going to participate in the ESPP plan, absolutely, that's a takeaway for sure. Great. So let's transition to our next question, which is how do all these changes affect me? How do I plan? What do I do to make sure I'm on track? I mean, there's just, I think, a number of questions as people's benefits shift and evolve over time. It kind of gives a reset to your thinking, and it may even elicit more questions about, retirement and saving, and obviously ensuring that the track is right in terms of hitting your target. So what can we tell people about that process and what they can think about, or what they can consider as they're thinking about their own individual needs?
I think what we really need to do is encourage people to create a customized financial plan. I said earlier, the pension number has never really been the right question. So how much my pension is shouldn't dictate how I plan to live retirement. It's a nice feature, of course, to have. And if you can live entirely within the pension, that's great. Most people can't. And so really what we need to shift our focus to is how much of a gap is there, if there is one, and how do I make that up? So much of that is personalized. It just depends on what are my goals in retirement? Do I plan to travel extensively? Do I plan to buy a cabin in the woods and just read books for my retirement because I've traveled so much with my career? So it's such an individualized decision that you really need to start with a plan, encourage people to calculate their pension benefits now that we have the pension modeling system up to date, to really give us some specific numbers. I know that the projections that were originally run were based on, I think, age 59 and a half. And so we know that not everybody retires at that age. So if it's before or after that age, we can start to get some customized models put together and then figure out how much more do I need? What else do I need to save to meet the lifestyle that I have or that I would like to have? And if that's not going to work, then what are some of the logical trade-offs? Mm-hmm. The other thing I think, we see a lot is that the picture about retirement changes a lot. So when you're 40, 45, you have kind of a wide view of what it might be. At 55, it really starts to narrow in. You start to understand, maybe it's the kids have gone through college, or they're ending up where you think they may stay. Of course, we never know where that will be, but all of those things will evolve over time. And so really having a plan that is flexible enough to allow you to make those adjustments and really make sure you're staying on track.
Yeah, that's great. And I would also say, as people think about that too, it's a little different than, say, a calculator, right? Where we sort of put in how much we've saved and how much we think we're going to spend. There's a dialogue that exists. There's individuality that exists, like you say, priorities for people. There's individual planning in terms of, tax and cash flow and what buckets to pull from and spend from when. And I really think that that's where, it really is important to be, have a custom approach or a personalized approach to that, because life changes, as we all know. And, I think just having that custom approach for individual needs it's a critical piece. Good. So, how can an advisor help me? So I think that that's kind of a dovetailing question, of course, but what's the nuance? Like, again, I think about, how we serve clients, Brad, and I wanted to say, there's a difference there. So how can we describe to people, if they are working with someone, the questions that they need to be asking, or what can we tell people just as to what to expect from an advisor if they're not already engaged with one?
Really, we differentiate ourselves based on a more proactive approach. And so retirement planning is often put in a bucket of, here's the resources I have, and then, I can take X% out per year. And as long as that works, I'm okay. Well, that's pretty simplistic in its approach. And so having an advisor that knows to ask the right questions, for example, how much will healthcare cost in retirement? How will that interact with my retiree benefits for healthcare if I have them, or if I don't have retiree health benefits? Asking questions about family gifting and charity and other things that have tax consequences or tax benefits, and really being able to look around the edge in the corner of some of the questions that we know you may not be asking at 45, but by the time you're 55 or 65, these questions will likely be coming up. And so that really proactive approach is important. And then making sure that it stays front and center. This isn't something that you can set and then 10 years later hope that you've maintained, being on track. It really is something that should be an ongoing conversation, and much more in depth than just a simplistic modeling tool. And so we strive really hard to make sure that we have that more robust approach. And that's just really all we focused on right now is the retirement planning. That's one element. There's a lot of other elements to what we do for clients as well.
Mm-hmm. Yeah, absolutely. Well, good. Well, I think at this point, I'd really like to open it up for questions and spend the rest of our time talking through some of those. I know we've had some that came in advance, and of course, we want to answer any questions that you've put through the chat box during today's discussion. So let's turn it over to Ellie to check in, our moderator today, and talk through some of those questions. Ellie?
Sarah and Brad, we have a question that came in, a direct message here. Will the minimum 401k contribution to get max employer contribution remain 6%?
Yes, if you defer 6% to the 401k, you will continue to get the 5% matching contribution. So Dow is increasing the matching formula. And so that will give you the ability to get that matching contribution. And then, as we noted, the 4% contribution that starts in the beginning of 2024 is non-elective, meaning it's not tied to your personal contributions. It is made by the employer without any action for you. And so that's, again, based on both base pay as well as your bonus pay.
Mm-hmm. So really the message, if you're going to write something down on that, what it is, defer 6% to pick up the free money or the employer contribution is really the key point. Yeah, great question.
One came in on an email earlier. How often should I refresh my plan for retirement?
Yeah, so I think that's an ongoing conversation. So I don't think there's a perfect answer for that. I'll say it depends, because I would say at least an annual review to make sure you're tracking in the right direction is likely the answer. However, life changes. So there are plenty of times where we're getting back together with our clients sooner than that because I've taken a different job. Maybe I've taken a step upward in pay or a step backward in pay or a sideways pay. There could be changes even in the life cycle as a working person, and certainly other life events, death, inheritance, divorce, change in, family dynamics. There are plenty of reasons why you would want to engage with that more quickly than say a year's time frame. But I would say, if anything, really just checking in. We like to check in and have a discussion on that point at least every 12 to 18 months. And obviously, if life changes, then we want to push that ahead even sooner.
Okay, and then another one that you sort of touched on, how will my ESPP cost basis be reported?
You want to take that one?
Sure. So the employee stock purchase plan, the cost basis will be reported based on the discount, the price that you've paid for the shares. So at the date of that transaction, which I believe Dow has said the shares will, the share delivery date or the offering period dates lined out in that recent employee communication, is that the actual share price and the date that it's set with that look back period we mentioned earlier, that'll be the cost basis that's reported at the custodian level. So whatever that is, that's what Fidelity will report. The nuance to that is that you'll actually receive the shares on, it says the week of December 6th, and the fair market price will technically depending on if you sell the shares or keep the shares. But the fair market price will be that data point that you'll want to write down. You'll want to put in your spreadsheet if you're a spreadsheet person. The date the shares are delivered, that's where you're going to want to note the fair market value on that date. So again, Fidelity is going to report the share price on the date, the plan price in which you're purchasing the shares. Remember, that's a 15% discount price, right? And so again, just making sure that you don't sort of run into trouble with the reporting, because the reporting documentation from Fidelity will report it as such. And you're going to want to make some notations as to the fair market value on the date that the shares are delivered to you. And then we'll kind of follow that trail through for the actual sale of the shares, which there's some nuances to that, whether you sell them right away or sell them at a later date. But that'll be the data points to certainly make note of for your cost basis tracking.
Okay. I've built up a lot of Dow stock over the years. Is there a reason I shouldn't just continue to accumulate shares and use the dividends to help meet my expenses in retirement?
It's a very common question that we see for sure. I think as we look at risk tolerance, that's the lens that we're going to look through. And so there are a couple of things that I think as Dow employees accumulate shares, many times, if not most times, it's going to be through different forms of compensation. And so not at all uncommon that we see people have shares that are delivered and then just held for a number of years. There's a couple of things there that are important to consider. One is if you are acquiring shares through a form of compensation, whether it's deferred or performance shares, the cost to you and your income is set at that time. So there is a lot of benefit of selling the shares immediately. You've already realized the income. There's no additional capital gain to have at that point. So from a tax perspective, you're kind of neutralizing yourself there from putting yourself in a position of, I have shares from years and years and years, and now when I do need to start to diversify or I need access to funds, I have a lot of embedded capital gain. So that can be a hurdle that mentally people have a hard time making that adjustment. So resetting your cost basis by selling immediately is a great opportunity. The dividend is great. We know that the dividend can be variable. And so the real risk factor, though, is having such a concentrated position in one company. And it's not a reflection of Dow. It's a recommendation that we give for all 25 company executives that we work with at various different companies. So 25 being, approximately the number of different companies that we provide this similar advice for. So it's not a Dow specific issue, but we really want to diversify. So you will continue to have risk factors with your employment with Dow, your bonus pay, tied into company performance, obviously the stock price tied to company performance. And all we have to do is think back to a couple of historical time periods where the stock price really underperformed the broader market because of various circumstances. And so that's a very risky situation to be in. And so we really just want people to understand that having diversification and being strategic about that decision is really important.
I have a personal question. Is SYM a fiduciary?
Yes, all of our relationships with clients, we act as a fiduciary. There's no gray area for us. Every single engagement that we have, we are always acting in our client's best interest. And that applies across all aspects of our business, both our personal services as well as 401k administration that we do for some clients. So you can always count on us that we are not going to be collecting commissions or any revenue sharing agreements or anything like that. Everything is clearly stated, open and obvious, and always in the client's best interest.
Okay. And then what differentiates SYM from other advisors?
Well, I would just back up to that fiduciary standard. So that is rare air for most advisors in financial services industry. Not every advisor is a fiduciary. So that's a number one question I would say that we get asked, and we would certainly say is a good question to ask your advisor. It helps to identify the difference in terms of the business model. The other thing I would just say, what's different and unique about us is our process. So we're really proud of the fact that we're an accountability partner. We're a project manager. We're a time leverager, and it's our job to make our clients' lives very easy. And so in our world, that's the satisfaction. That's why we get out of bed every day, because we enjoy doing that. And so, for many of our clients, they're busy, they're working. Yes, they can do this, or they may have been doing this, and it gets done at 10 or 11 o'clock at night, or on a Sunday when they want to be out, playing with their kids. It is extremely important to us to provide value over the entire life cycle for someone. So it really is to us important. There's different things that come up when you're working, when you're retired, when you're, in different stages in life. And so I think just having a partner to look around those corners, I'd say that that's a real big difference for us, and the proactive approach that we take to that. Would you agree, Brad?
I do. And I think, one element that you will find that's very different about SYM is that we engage well beyond some of the areas that you would typically see for advisors. So we've talked a lot about retirement planning, savings opportunities. So all of our clients are certainly going to need a financial plan, and we help construct that. But financial planning involves estate planning, tax strategies, whether currently or in the future in retirement. How do we maximize withdrawals at maybe lower income tax brackets? Looking at property and casualty and other types of insurance. All of those are areas where we have expertise in-house to lead a conversation. And so our goal is to make sure, one, we're bringing these topics up because it's very easy just to say, well, yeah, I know that my insurance agent has that handled. I don't really need to look at that. And what we found is that the insurance is typically adequate, right? But there's and just as one example, but there's often some opportunities that we can tweak to maybe save a little bit of money based on what your personal actions would actually be. And so just really raising those questions for a critical look, and then working with other related professionals to implement those types of changes. So I think it's really important that it's an all-encompassing relationship. We want to provide leadership on more than just a financial plan and investments. Investments are a great tool to meet those goals. And so all of those things, though, need to be coming together to meet the goals of the client and really live an optimal financial life.
Mm-hmm. Absolutely.
Okay, I'm seeing one more question, and I will call out any questions that you enter are private, so don't be shy. The last question I see here is, what benefit is there to engaging with a financial advisor when I can purchase a low-cost ETF with broad market exposure?
So if we focus in on the investment side of things, we haven't talked about investment strategy in terms of how SYM approaches that. Our investment strategy is directed by our investment committee. And so you don't get Brad or Sarah's stock pick of the day, which we both agree is probably the better way to approach that. And we do that in a low cost manner. So the funds that we use in our portfolio, we try really hard to make sure that we are using institutional share classes and really managing those elements of expenses to the portfolio. Typically in a relationship, you are looking at investment management and financial planning kind of together at the same time. So there isn't really a separation of the two in many cases. And so what you're really getting is that thought partner by engaging an advisor, being able to provide that strategic thinking, being able to anticipate those questions and know, we can invest as much money as we want into index ETFs, but what's the ultimate goal of that money? Is it being done not necessarily optimal from an investment standpoint, but from a utilization of those funds in the future? And how are we doing that? And what are we really working towards? That's something that even with online advisory services and robo-advisors coming into our industry, you cannot replicate that relationship. And we've continued to find that over and over again, that's really the added benefit. There are some things that advisors do. There's been multiple studies from different sources like Morningstar and Vanguard trying to quantify the value of an advisor. And they'll look at things such as rebalancing, perhaps keeping you in the market last March and not getting out and pulling the ripcord and then failing to get back in the recovery, and multiple other different elements that really quantify the value. And overwhelmingly, these independent studies suggest that there is significant value over and above just in investment returns.
Mm-hmm. Yeah, and I would just tag on to that and say, you know, that is really that value proposition piece where you're having that dialogue with someone, and it's someone who's gone over this ground before. And for many of our clients, it's the first time that they've gone through. I mean, again, right? I mean, for most people, charting a path through their financial lives is the first time that they've done this. So why not have a trusted professional to help guide you through that path in life? I think it's priceless in our opinion. So.
Thank you. That's all that I have.
All right. Well, wonderful. Thanks, Ellie. And so in closing, we obviously want to welcome your conversations to continue these discussions, advance these discussions. If you want to have personalized discussions, we obviously welcome that. We will follow up by email and give you an opportunity to connect if you so choose. Of course, we want to also pop up our contact information on screen. If you do want to scribble that down and reach out to us individually, we certainly welcome that. And like I said, we just really appreciate the opportunity today. We find that in serving our clients, you know, we know they have a lot of questions like this. So hopefully we've kind of addressed the wide breadth of information that helps get you tracking in a good direction to help optimize these benefits. So thank you so much for taking the time out of your busy days to join us. We look forward to connecting with you further. Thank you so much.